Would be a mutual fund, a couple of them. Low fees, high fees, internal charges, they both are earning about 7.5% before fees. But look at this one case where it's very low, like an index fund, 0.1%, whereas a mutual fund might be closer to 1.25%. You run that out, $500 a month over 35 years, low fees, $991,000. High fees, $755,000. That's still a nice big number, but you're missing out about $250,000 just by not considering fees.
Yeah, fees is the silent killer, right? So everything is going to cost you something. So you can't get anything for free, right? But understanding what you're paying and making sure that you're getting value for what you're paying is key. When you get into higher fee type mutual funds and investments, that's when you get into the active management again. You have a portfolio manager that's trading the overall mutual fund, trying to beat the overall market, right? Or protect you when the market blows up. So there could be value there, but just understand what you're paying. I think a lot of you don't have a clue of what you're paying. And so I would encourage you to probably take a little bit deeper look there to see what those internal costs and fees are.
Yeah, and I think the other part of this is taxes. And you do have some measure of control over your taxes. And let me give you a couple examples. One is what we call asset location. And a lot of people really ignore that. Asset location just simply means putting those asset classes like stocks versus bonds, higher performing asset classes over the long term, put those in tax favored accounts, like a Roth IRA. Like a non-qualified or non-retirement account. Why? Because they have lower taxes on the gains. Roth is tax-free, non-qualified accounts, capital gains. If you put your stocks in your IRA, your 401k, you're just going to pay higher ordinary income taxes in the future. Another thing is tax loss harvesting, and that's when markets go down. You have positions that you bought here, now they're down at this point. We want, if it's outside a retirement account, you want to sell those to create a tax loss. We want you to buy something similar, so you're still in the market. You will receive that market recovery. But in the meantime, you've created a loss that you can use against all other capital gains and it carries over actually for the rest of your life. So it's a great way to minimize your taxes. And volatile times, Joe, like we have right now, is a time to be considering that.
Yeah, I mean, you look at fees and taxes are key. Those are things that you can't control. You can't control the markets. We can't control interest rates. We can't control, all sorts of different stuff that we're experiencing right now. But we can't control certain activities, and that's what it's all about, is trying to avoid those mistakes so you don't dig yourself a deeper hole.